Joining us now, G Squared Private Wealth CIO Victoria Greene and CFRA Research Chief Investment Strategist Sam Stovall. Victoria, I'm going to start with you because we started this week in the green, and that had been the case for a number of weeks. What we would see is we would start the week strong and then fade the rally, and it would get uglier as the week would go on. The fact that that did not happen this week, the fact that we have closed the S&P 500 at 4360, well above the 200-day moving average, how bullish is this?
It's manic, not necessarily bullish. It's great you got some lift. We saw that bounce off. We saw the buy the dip work. They, buyers stepped in as they've been doing all year. But for me, you're still a little bit facing some downtrend winds from that July high. So I'm kind of still holding my breath, see if this manicness will hold next week. Because we've been lurching from everything's terrible after like Tesla, Google, and Meta to everything's fine. And even an Apple miss we're willing to overlook because the Fed's going to just rescue us all. So I think we just have to step back, take a little bit of a deep breath. These grades are great. Everything rallied. Bonds rallied. Stocks rallied. Gold was off a little bit, but not terrible. Energy rallied even with oil prices down. It's just one of those Goldilocks weeks. But again, we're going this manic, like everything is terrible, everything is amazing. So take this week with a grain of salt, enjoy it, but just realize it's kind of 1 in a million week. Yeah.
Sam, I want to get your thoughts on this, especially since stocks did very much take their cues from the bond market. And we saw this rate reprieve for a number of reasons. You saw that refunding, that Treasury refunding overhang was removed. You had softer macro data, including the jobs report today. What some folks have called dovish Powell commentary from the Fed decision on Wednesday. And then some dynamics globally as well with the BOJ policy tweak. The fact that we touched 5% on the 10-year yield, and then that was it. It was very fleeting, and we came back down. Rick Santelli had said to me earlier today, that's because at that yield, it's become more compelling and bonds have become more competitive against stocks. Do you see it the same way?
Well, Morgan, what I see is, as Victoria sort of said this week, is investors were pulling petals from a daisy saying we should buy versus we should sell, we should buy, we should sell. So in the near term, I think investors were saying, okay, let's see what's setting up this overall market. From a seasonal perspective, yes, we've come to an end of that very cautious sell in May period. We have entered into the fourth quarter, which traditionally is good, but it's even better when it's a pre-election year of a first-term president, since it's never declined since World War II. Also, investors are saying, hey, the Fed is likely to be finished raising rates. And whenever that has happened, we traditionally have seen the market up 13% in the 9 months between the last rate hike and the first rate cut, along with all styles, sizes, sectors, and almost all of the sub-industries. So I think investors are going to take heart with today's action or this week's action, but they're also going to be very vigilant to see whether that 10-year yield was simply a fake out, head back up to the 5% level. For certainly it is adding to the substitution possibilities that we did not have during the prior bull market.
Victoria, something else I'd like your take on. The Russell 2000 was up almost 3% today, about 8% for the week. That's better than all but two of the stocks in the so-called Magnificent Seven, the mega caps. Amazon and NVIDIA were both up more than 8% for the week, but those are the only two. Does that speak to a shift in this trend toward the bigger stocks outperforming with these smaller stocks catching up?
I still think the mega caps are going to be the make or break on this market. NVIDIA doesn't report till later in November, so we'll look to see if they can continue the semi-strength or not. Look, the Russell 2000 has had such a rough year, and that's been one kind of the issue with this bull run here is that the small caps haven't confirmed yet. So yes, this is a good sign that you're finally seeing the small caps participate. You saw EM participate, the dollar fall, but you have a lot of questions on how much of that growth in the small caps is really sustainable, especially with liquidity and lending and kind of putting more and more pressure on the smaller companies. It's harder for them to refinance. It's harder for them to access capital, especially as we've seen these financial conditions tighten. I'm not really buying that this was the end all be all and here it's going to be a small cap run from here to the end of the year. I think you still stick a little bit with your mega caps because I like the quality and balance sheets that they have much better than I like the small cap balance sheets.